Thank you all for joining us here at the AAII National Community Group for the Income and Cash Flow Special Interest Group or SIG Group meeting today. I'm Todd Blickenstaff, the president of the Portland, Oregon PDX chapter and coordinator, and I'm also the co-coordinator for the AAI Community Income and SIG Group meeting, along with Gilbert Ho, who's also a co-presenter today, aided by John Wong, our webmaster as well. And I'd like to tell everybody. As far as we're going to have two different presentations today, and we encourage everyone that's on the call today to, if they have any questions, to enter them in the Q&A section, and then at the appropriate time, we'll make sure that those questions are answered during the respective calls. And did want to say, since we have this question already, I will tell you we are going to provide access to the. He's calling me on that, that we're going to make the materials available, both a recording of the presentation and the presentation decks for the two respective presentations. Those will be available at a later date for those of us those that may not be able to join us live today. Everyone that signs up for this call will get an email later on from John Wong. I'm going to guess probably next week, John. Is that realistic? And to provide those materials. And then, so let me talk about what we're going to be doing today, and that is we have two presentations, and there we're going to have, first of all, Gilbert Ho is going to be talking about providing his monthly economic and market overview that he does whenever we have these calls. So we tend to schedule these calls either every month or every other month, depending on the topic and speaker availability. And so we're going to start that out, and Gilbert's going to go first on his presentation. And after that will be followed by William Gregg, who will be presenting on MLPs, or Master Limited Partnerships. And so we're going to go in that order. And again, we encourage you to enter any questions you have in the Q&A section on the site. Not that's where you should address them, not in the chat section, but in the Q&A section. And let's go ahead and queue up Gilbert's portion of the presentation, and so that we can begin that and go from there.
Okay, thanks, Todd. I'll start sharing. Let's see. Wow, can you see the screen? Let me try again. Share screen 2, share. Okay, I hope it showed up.
Yes.
Okay,
I've
cool.
got a picture of a body of water. Oh, yeah, there we go. Okay.
Yeah, I wish I was there. But
okay.
Yeah, so this is the economic review, and it's the topic of the slow-moving economics. So the usual disclaimer, please treat this information as educational and entertainment purpose only. And particularly the data is the backward looking, and the market is forward looking. Okay, so first thing we want to talk about is the FOMC meeting that just happened this week. So as expected, they cut the rate by a quarter point. So now their Fed fund target is between 4 and 4.25. They are continuing their quantitative tightening, which means they're letting the bonds they hold, the treasuries and the mortgages bond they hold to mature. and not purchasing new ones. Now, every 3 months, I think quarterly, they go around the table, I guess, and ask participants opinion, and then they form this so-called summary of economic projections. That's basically a survey. And as you can see on the lower left, under the column 2025, they have hiked up expectation on GDP growth, but unemployment and PCE inflation are pretty much the same as last quarter. And on the federal fund rate, they did expect it will go lower. That's where you will see, news saying there are 2 more this year because they are taking 4.0 minus 3.6. That's 0.4, almost 2 quarter point rate cut.
I think that was a narrow majority, I think, of the voting Fed members that said they would favor up to 2 more rate cuts this year. I think and I believe, yeah, you're right. It said about 25 basis points. So we could see as many as 75 basis point reduction. And I noticed also, Gilbert, that the Fed chair in his accompanying comments really mentioned downside risk frequently in the presentation. So the Fed has definitely moved in the direction of wanting to shore up the economy and concerned about a soft job market.
Yeah, ever since COVID, I think these economic data are very confusing. But if you look at the dot plot, which is their survey of the FOMC members' expectation, you can see that on the 2025 column, as of this meeting, it's pretty much close to where we are now. I do want to point out there's an outliers who wants to cut 2.2% or close to that, and we all know who that is. And I think that group will grow as time goes by.
Yeah, were you referencing the new Fed appointee?
I think he's the one.
Yeah,
He's the
Stephen
only
Moran,
one. Yeah,
right.
he's the only one who voted against this quarter point because he wants more.
Yeah,
not
150
less.
basis points,
Yeah.
right.
But anyway, so that's but if you look forward, 26 and 27, they're still looking for lower rates. So that's good in general. Anyway, the last point, I just take this out of their statement, basically saying their dual mandates, the inflation, control the inflation and the unemployment rate are in conflict. And so this meeting, they're favoring boosting the unemployment. And this week, no, I'm sorry. Later this month, we'll get an update on the unemployment data. So we'll see. So that's the FOMC meeting this week. And now we're going to look at the interest rates. The first one is the long-term treasury versus the short-term treasury. And the 10-year versus 2 years are pretty obviously positive. The old reliable 10-year versus 3 months are hovering around the 0 point. So it's not a clear cut of an inversion, but we'll see. And so yield curve flirting with the inversion. If you look at the 2-year treasury and the effective Fed fund rate, this is as of yesterday. So that's where there are 2 cuts, the room of 2 cuts there, because the market is expecting lower rate. The blue line is below the red line. And then if you look at the spectrum of the maturities on the treasuries, on the short-term rate, monetary policy is lower. We have been coming lower, but it's still not as a clean curve as in like January of 2022, which is the yellow line below. So there's room to cut short rate, assuming the long rate stays. And the long-term rate other than quantitative easing, the Fed does not control that. It's market control.
Gilbert, can I
And
ask a question?
I'm sorry. Yes,
Can I
go
ask a
ahead.
question? It seems like they're stepping on the gas when inflation is still at 3%. Is this the right time to be doing it, especially with these tariffs coming? I suppose are going to continue to be affected.
Well, I think as Paul said last month and this meeting, they think the impact of tariffs is a one-time step function. So that may increase the rate in the short term, but they don't think it's sustainable in terms because the tariff, you don't keep on increasing it. So that's where I think that's how they justify it, because you're right. The inflation rate lately has been up. We have a chart to show that later. So that,
well, yeah, and I think it's also true that the federal inflation rate hasn't even averaged 2% over the last 20 years. Most of the time, it's been closer to 3. So it's not a given that they'll get it back to 2. And also, Jerome Powell, the Fed chair, did say that monetary policy really isn't an effective tool for dealing with tariff strategies and immigration crackdowns too. So those are not under the auspices of the Fed's control. So, and I believe what last time the Fed did cut short-term rates, long-term rates went up too. So there's a lot of variables here, and it's a pretty muddy economic environment, as I'm sure you'll point out, Gilbert, in your additional slides.
yeah, 100% agree. It's very muddy. Let's see. So they looking at quantitative tightening. The blue line is the Fed's balance sheet, and the gold line is the M2 money supply. You can see that M2 money supply hasn't grown. It's pretty much in a trading range in the last since 2022, and last we see this that's the trillions in both numbers, and as of end of last month, they reduced 26% or a quarter of their balance sheet. The target was 33%. So they're continuing to do that, although in a slower pace.
Oh, okay.
Yeah, so which is good. And then so we look at this is the end of the month commodity futures, the 12-month chart, starting with gasoline. Gasoline was pretty low at the end of last August, but I think lately it might have crept up. Natural gas is winter is coming, so expecting that to go up. And copper, interestingly, was going up, and then I think there was a tariff announcement and crashed the price. And I think eventually probably going to creep up again if the growth is there. Corn was in a downtrend before, and your steak, the light cattle, is continuing to go up. Lumber seems to be going up and down. With the lower rate, maybe it'll go up again. So those are the commodity futures. On the inflation, yes, go ahead.
It was interesting. There was an article in the Wall Street Journal earlier this week about how well the cattle ranchers are doing right now, because
Yeah,
demand for beef is so strong that it's a better situation they've been in quite a few years.
yeah. This, if you look at this since September 24, the trend is up. Okay, looking at the PPI, which is the purple line, it seems to be flattening, so we don't see much change. The interesting part is the green line, which is the export price index. It's going up, and import price line, which you expect to go up, it's sort of hugging the zero line. And so the question is, will tariff drive the import price higher? Probably is, just not showing up here. Here is the, like William said, the inflation rate. The blue line is the CPI, consumer price, what we see. And the red line is the core PCE, which is what Fed used to judge the inflation. And both are, in the last 1, 2, 3, 4 months are going up. So William is absolutely right that they're cutting rate while the inflation rate is going up. But my personal view of this is probably 3% should be the target.
Agreed.
Yeah, so is tariff going to do that? And this one is the University of Michigan's inflation expectation survey, the blue line, and red line is the CPI. If you go back to all the way go to the 60s, this survey is pretty good. Has a very good correlation with the actual CPI. So it is surprising that in the last 2-3 months, we got a spike, and that's people are expecting inflation to go up, and the red line actually stay low. So hopefully it's a false alarm. And finally, this is the supply chain index, and it was very useful during the 2021 inflation cycle, but it's not showing any constraint there. This was a chart I just want to show that the inflation components for the last 55 years. We can see that the food price is going up, the energy goes up and down, but the services is consistently growing faster, and so services definitely contributed a lot to the inflation rate. And the question is, will AI and robotics eventually put a damper on it? The last during the 2010 to 2020, that period, I think China's cheap labor contributed to lower inflation. So maybe the AI and robotic will probably contribute to lower inflation in the future. It's just a hope.
Well, and one would think that that services inflation line is the steepest, that yellow curve,
Yeah.
and you'd think that that might be an area where AI might have some pretty relatively strong impact to bring it down. But it's kind of striking how that service line is as steep as it is, particularly in what's a slowing economy around most of the world.
Yeah. Okay, so job opening, this is earlier this month, and we're going to get another one in 2 weeks. So now, we have the same number of employment and job openings. This is kind of unique. And looking at the full picture, we can see that actually job openings, the purple line, are pretty flat. We're back to 2018, 2019 level. And then you look at the hiring rate and separation rate, they're also back to normal or sort of on the low side. And number of quits, percent of quits indicates the tightness of the labor market, and it's normalized also. So there is no pressure on labor market for like what happened in beginning of 2022. And, like I said, if you have a heartbeat, you can find a job. But right now it's back to normal. But looking at the initial claim, this is from this morning, we have a spike. It's and the continued claim, you can see that gold line seems to be going up, but if you zoom out in a big time period, you can see these are really, really historically low. And looking at the all employees numbers, total non-farm, this I'm using a non-seasonal adjusted year-over-year rate. And anytime we are below 1.0, that usually shows a weak labor market. However, there are a lot of discussion about the way they get these numbers are, started in 1950s and are still the same. So maybe they need to revamp the method.
Mm-hmm.
In terms of unemployment rate and labor participation rate, all I can say is they look, unemployment rate is still historically low, and labor participation rate is sliding, mostly due to demographics, I believe. Finally, looking at the income level, they're above, the annual rate change is above inflation, so I call it healthy. This is actually showing the unemployment rate in Silicon Valley, and surprisingly, it's going up in the last 2 months. But going back 3 years, every April to August, they are always spiking. So hopefully it will come down. Now, looking at ISM data, the manufacturing PMI has been and continue to be below 50, which means contracting. The service PMI is up above 50, which means expanding. So again, manufacturing is not going too well, but service is doing pretty well. In terms of this particular data series derived from GDP, which is what Chairman Powell mentioned many times, this is what they use to look for consumer, indicating consumer demand. And it's softening in Q2, but it's still up there. No signs of cracking. The Atlantic Fed's GDP now, which they forecast nowcast the Q3 GDP. Currently, they're expecting a 3.3% growth, which is pretty strong. And finally, the leading economy indicators from Conference Board, they have this indicator, which is their called 6 months growth rate. And you can see that it has been giving recession signal in the last 3 months. And the question is if, they did that in 2022, which is like everybody else, but nothing happened. So is this another call, a false alarm, or this may be true? But this indicator has been very, very reliable before 2020 for a long time. So that's pretty much all I have. And thank you very much.
Okay. Thank you, Gilbert. I noticed one of our attendees it was, I think, more of a question than a comment, but or a comment more than a question. But monetary policy needs coordination with fiscal spending. Yeah, that that would be nice for a change. We don't get much of that out of DC, but um, it's um, it's going to be very interesting to see. I know the administration is hoping that we're seeing revenues coming in from tariff, and that will help bolster the economy and hopefully bring expenditures in line with tax revenues. But that has yet to be seen. We'll see how much of a factor it is over the next year or so, because there's going to be a delay with the tariff revenue coming in. I think it's going to be quite a while before the Fed and governing bodies get a handle on that, and how that trend's really going to materialize. So, thank you very much for that presentation, Gilbert. And if anybody has any questions that come to mind later on in the presentation, even though we're going to switch topics, we can address those later in the presentation as well. And so what I'd like to do now is let's go ahead and transition to our second speaker, main speaker for the day, on the topic of investing in energy MLPs to generate income and cash flow, presented by William Gregg, who's been presented multiple presentations for us on other topics that he's studied. And so we're looking to go ahead and transition to his slides so that William can move forward with his presentation. So give us a couple of minutes and ensure that we'll have that on the page. Okay, here we go. And again, you're starting with, I'll go ahead and turn the microphone over to you in just a second here, William, although I shorted you on your bio. I wanted to say, and after initial career in banking, Williams provided career as successful intellectual property entrepreneur, is currently self-employed and is a product developer, licensing over 20 products to companies in several different industries and market channels, and studying cash flow investment vehicles like MLPs is a passion project for William as well. And he's accumulated a financial expertise over the years as he's studied products like this. And MLPs can be a bit complicated, and but I'll let him go into the details on that and take it from here.
Thank you, Todd. Okay, the first slide I'm showing is just the different asset classes that we as an investment, income investment group can be looking at. I know we've already done presentations like with Andy with his dividend growth stocks. I think Todd did one with BDCs. I think you did, Todd.
Yeah,
I did one on CEFs, which isn't really an asset class. It's just a wrapper, sort of like ETFs.
closed-end funds, right?
Right. And then we did that work on annuities, but I've kind of listed the 10 or 12 different categories here. All these investments are available to be purchased individually or through funds, except for annuities, which is through an insurance company, and CLOs, which are generally best purchased by small investors through funds rather than direct.
Right. And we'll have additional presentations in future meetings on some of these topics too, and sometimes by more than one presenter to give different perspectives on these particular asset subclasses.
Next slide, John.
Okay. All right. Thank you, Gilbert.
And then the next slide will start and the next one after that. That's just showing an example of midstream oil there. So first up is the history of MLPs, master limited partnerships. They were first started in 1981 with the company of going public as Apache Petroleum. As a limited partner, it issued a 1040 K1 form for your federal and state tax purposes. Due to concerns that this was eroding the capital base, the tax base, Congress passed a law in 1987 treating these partnerships as corporations, with an exception that if they distributed 90% of their income as qualifying income, that they could be not taxed at the partnership level. So it's basically just a limited partnership that is publicly traded on an exchange. In the case of, there's several different types of MLPs. I'll go into those, but we're basically concentrating on oil and gas MLPs. They don't own the actual commodity. They never own it. They just store it and move it from one place to another and act as a toll bridge, like as a toll taker. It's said that these companies are not influenced by price volatility because they're not actually owning the commodity, but it's not exactly true. The prices of these do tend to go up based upon, the movements in the actual underlying commodity. The type of MLPs that are in this area are moving oil, gas, coal, timber, ethanol, biodiesel, propane, and other commodities. They have to make distributions at least quarterly. And overall, to buy an MLP, the reason why people buy them is because the distribution is just higher because there's no federal or state taxes on the entity itself. And that's why people bought MLPs, because it avoided corporate taxation at that level. That's why you get the K1 as a partner.
And because they generate the cash flow, right? So.
Yeah, and they distribute their income out as cash flow. Next slide. MLPs in general are referring to oil and gas companies, but there are some in other sectors too. It kind of surprised me when I was studying this how many there were, and but they're not really the crux of this presentation. But I just wanted you to know that there are some MLPs in shopping malls, apartments, and data centers. Brookfield Property Partners is an example of this. Next slide. There's also infrastructure MLPs that are into power transmission lines, railroads, ports, toll roads. And that's another Brookfield company that does that, specializes in that, Brookfield Infrastructure Partners. And there's even financial investment service MLPs. Alliance Bernstein, Apollo Capital Management, and Blackstone Group. Next slide. There's also MLPs in commodities other than oil and gas, such as in coal and fertilizers. Alliance Resource Partners LP is one. I own that. It's a coal. It's basically into coal. And finally, there's some in renewable energy, the transportation and storage of renewable fuels. And there's a Brookfield Renewable Partners that does that. And then the last one I saw was in royalty interests, companies that own, interests in claims for oil and gas fields. Blackstone Minerals is a big one, and Dorchester Minerals. Next slide.
And William, let me stop you for a second. Some of those royalty companies are Canadian based, aren't they? I remember the Canadian Royalty Trusts, and I'm not sure how the breakout is between the US and Canada with exposure to those royalty trusts. But
I think there are some Canadian. I was kind of concentrating on the US ones.
oh, okay, so you're this. Okay, gotcha. Thank you.
So basically in the oil and gas industry, and I think most of us know this, is that there's three different stages of activities. One is the upstream, which is the exploration and extraction of the commodity. We go to the final one then we go to the midstream where it connects the upstream and downstream sectors, and it's known as the midstream sector. And then finally, when it goes to refining and distribution of the refined oil and gas, is generally also called the downstream sector. Next slide. So midstream sector ensures the steady and efficient flow of energy resources between the other two sectors. It includes transportation of the oil and gas, carbon dioxide, hydrogen, utilizing pipelines, tankers, barges, and rail cars to move the product. Storage tanks for oil and underground storage for natural gas, processing operations to remove impurities, separate components like natural gas liquids. It connects the raw crude oil and gas production upstream with the refining sector downstream. Some companies are totally integrated. They haven't broken off their midstream sectors. This is particularly true with foreign companies. They are in all three sectors. And there are some large US companies that just have continued to run all three, but most of them have broken off their midstream operations. In Europe, most are fully integrated. They're not broken off. Next. Again, as I said before, in the midstream sector, have oftentimes been broken off from their upstream companies. The companies in the midstream sector are formed as MLPs. Some of them, and this is the new change that's happened over the last few years, some of them have dropped their MLP status and are now operating as regular corporations. I'll get into that in a minute, but they're just basically like any other corporation. They're no longer a master limited partnership anymore. I'll give you some examples later. For instance, the US alone has a network of pipelines with more than 2.8 million miles of pipe. The crude oil pipelines themselves are approximately 85,000 miles of pipe. And the next slide shows, I just put in the natural gas transmission pipelines. If you look over on Oregon and see the pipelines that are running through Oregon, they're owned by a company called TC Energy. It's not an MLP though. It's one of the ones that has transferred back into being a regular RIC company, regulated investment company. And
40 Act kind of company, right? Yeah.
40 Act kind of company, just like any other fund. And TC Energy also happens to own the Keystone Pipeline. Next slide. So I've just listed here the of the oil and gas pure play public MLP companies that are still in operation, that are issuing their K1. And the first one I listed here was Magellan. And I shouldn't have listed it, but I did because it's been the biggest one. It's been there forever. But just recently and I owned it, but then it merged with a RIC company, regulated investment company called One Oak. And now it's absorbed into One Oak. So it's back to issuing a 1099. But the ones that are still pure play MLPs, and you probably heard of many of these, is large companies, midstream companies. There's Energy Transfer, MPLX, Western Midstream Partners, which I do own some shares in that, Plains All American, Hess Midstream, Enterprise, the big one, Enterprise Product Partners, and then Sunoco and Cheniere Energy Partners, all midstreams that are still sold as partnerships. Next slide shows some of the ones that used to be MLPs, and you could have purchased them for MLPs for years, but now they've converted to being standard C corporations, and what they do when they do that, it's commonly called a roll-up, where they just, and then they become just a standard corporation. Williams Company was an MLP. Now it's just a standard corporation that has to pay taxes at the corporate level. Kinder Morgan, same thing. Again, One Oak has acquired Magellan, so it's also that. Targa, Antero, Enbridge was a huge MLP. Now it's a regular corporation. And Cheniere, which is basically, offshore, the movement of liquefied natural gas. And that same TC Energy is now converted its gas operations so that the gas pipelines in Oregon are owned by that as a corporation, not as an MLP. Next slide is I'm showing some of the returns, and I did this as of August 21st for this page, and showing these same companies I just mentioned that are pure play MLPs that are still operating there. I still put Magellan in, but I didn't put the numbers in because they're not an MLP anymore, but they were so large, I just left it in there. So it shows the returns there of the yield as of that date and the 5-year yield with dividends reinvested is the second figure. So if you can just look at that for Energy Transfer, MLPLX, Western, Plains All America, Hess, Enterprise, Sunoco, and Cheniere. And those are the yields as of August. I also put in another MLP that isn't really a midstream, but I've been reading about it lately, called Cross America Partners. I put it in because I like the company and the yield. It's actually a downstream MLP, which is something new that I didn't really know about, but it isn't in really the same business as these others. It's basically a wholesaler. You can see that its yield and its 5-year return. It's basically a wholesaler distributor of fuels. It also operates of convenience stores. It's also an owner and leaseor of real estate. It's about $1 billion market cap company with a low beta and pays quarterly. And I just threw that in because it sounded interesting. Then we get to the next page. We're progressing here pretty well. And this is where it gets a little bit more complicated, but how are MLPs taxed? Everybody knows that that it qualifies for a wide range of tax deductions. You're going to get a K1 if you buy an MLP. they pass through their income and deductions without the company paying taxes on it. So the distributions in excess of income, which oftentimes there is no income because of depreciation, but you get a heavy dose of return of capital. Sometimes 70 to 100% of distributions are considered a return of capital. This income is taxed at ordinary income rates with a 20% qualified business income deduction, a QBI deduction for the income. It's generally better to buy these in taxable accounts because of the fact that it's a return of capital. Dealing K1s, as we all know, is very difficult, especially with ones that are operating in many different states. So what happens here is the taxation for just about all the income is generally deferred until the security is sold. An investor gets cash but pays taxes later. Only if the cost basis reaches zero does any further distribution get taxed as capital gains. So that takes quite a few years. Owning these in a tax advantage account can result in unrelated business taxable income, but I found that the one that I own, it's so small, it's just negligible. And then the other benefit of these things, if you have it in a taxable account, is that, once the owner passes away, the heirs get a stepped up in basis anyway.
Yeah, I think the UBTI was originally constructed to kind of level the playing field between taxable and non-taxable structures. But and as you point out, it's a big deal, and it's probably a big deal for tax preparation. But as you mentioned, it doesn't tend to be that significant tax-wise for as a flow through to the investors in the funds or in the instruments.
So I mentioned before on the next slide that the MLPs have recently been, reforming and rolling up into being just standard C corps. And so I tried to look up the reasons why this is happening. It's obviously one main reason is that the K1s became too complicated and the accountants were going nuts over them. And so some of the firms are choosing to just roll up into a C corp to take care of that problem. All these midstream MLPs have IDRs or incentive distribution rights that go to the general partner. And sometimes they were getting higher and higher percentages of cash flow. So, the limited partners didn't like that. So it's another reason why they changed.
Well, we got a question actually from one of the attendees today if they broke off these assets, from to get the lesser earning assets out of the portfolios like many companies do and restructure. Was that an incentive for some of these companies to do that, or is it more tax driven?
You mean the formation of midstreams in general?
Yeah. To move them into, to splitting up between, I think, the upstream and the midstream and the downstream, and also to convert them to C corporations from the MLP structure. A lot of that is really tax driven, isn't it? So
Yeah, it's heavily determined on tax there. Going back to being a C corp, they found that they can better manage their cash flow. They don't have to pay it all out. They can just they don't have that restriction, sort of like REITs have, so do these MLPs
right.
they have. And of course, they thought that by doing this, they could just attract a wider variety of investors.
Mm-hmm.
So I looked at the returns on the MLPs that have been converted, the list I had before that have been converted to C Corp, just to see how their returns are versus the ones that are still MLPs. And so you can see, from Williams, Kinder Morgan, One Oak, which now owns Magellan, Targa, Antero, and Bread, Cheniere, and the TC Energy, which is the pipeline owner of the pipelines in Oregon. You can see they're all kind of lower returns than they are as they were than they were as MLPs or as the other MLPs are because of that tax effect. They're having to pay taxes and then distribute their dividends, and that's kind of the big difference. On the next slide, I just threw in a purchase that I made. I don't know why I just decided to throw this in. I didn't actually buy the MLP itself. It was a small MLP called Crestwood Equity Partners LP, and I bought a preferred that was a 9.25% preferred, but it had a par. Most preferreds have a par of $25. This one had a par of $9.13. And the reason was because it wasn't a normal preferred issued by the company. It was an institutional preferred that was that the company bought, and institutions can negotiate better deals than individual investors can. And that's certainly what happened here. And so the actual par was $9.13. I bought it for $9.17. So since it was a 9.25% coupon rate, I was getting, and still am getting, 9.16%. It's non-rated. It can't be called, has no maturity date. It's kind of my best oil investment that I think that I've acquired. It itself was acquired by Energy Transfer, so it was acquired by a much bigger company that's still an MLP. So the preferred is still 9.25%. The price now has raised to 11.41. So to buy it now would yield 7.40. You're getting the kind of like the fact that a better company bought it, so it's even more secure than it was before. So I keep holding on to that one.
Mm-hmm.
Next slide is we've talked about how you can buy MLPs themselves and then MLPs that have been converted to corporations. Now let's look into how do you buy them in funds, and basically these same MLPs and these corporations that are no longer MLPs can be purchased through ETFs, CEFs, mutual funds, and unit investment trusts. I'm only going to consider ETFs and CEFs here. So the next slide is there's basically two types of funds to consider. Both of these funds issue a 1099, not a K1. So this is where you can you can buy these stocks and not have to face a K1. And so the first type are funds that have bought, that are weighted with more than 25% MLPs in them. And I'll give you four examples of this on this page. And as long as anytime they own more than 25% MLPs, and in these they own all the MLPs they can find, and so they're basically C Corp MLP funds taxed as a corporation. They retain the tax characteristics of the underlying MLPs, and which are tax deferred return of capital and qualified dividends taxed as long-term capital gains rates.
Mm-hmm.
Don't create unrelated business taxable income, and they just issue a simple 1099. When you buy these MLPs that have all these MLP funds that have all MLPs in them, it's best to probably purchase these through your taxable accounts because of the tax deferred income benefits. I'm giving an example of 4 ETFs here, the only 4 I could find that are all MLPs. Biggest one is Alarian, which has been around a long time, has almost 8% yield. It's 10 billion in assets. Generally 80% of it has been tax deferred. It has a low beta, and a 0.85 expense ratio. The other one, and that's is MLPA. It's pretty much similar. It's just a smaller fund. And there's an InfraCap MLP fund, ETF fund, and something called Energy Income Partners. FT Energy Income Partners is the smallest one I could find.
Mm-hmm.
The same next slide is the same MLP funds that are mostly MLPs, both in oil and gas, and they can own any MLP, but can also be purchased in a CEF wrapper. And most of these CEFs that were taxed as corporations,
Got closed-end funds, right? Yeah.
closed-end funds, instead of ETFs that are bought as a CEF, they've either merged together or they've been converted to the registered investment company under the 40 Act, or they just liquidated. So I could only all the same aspects of the MLP ETFs are in place here, but I could only find three. I own the middle one, Kane Anderson, but this ClearBridge one, which yields the most, is a combination of a lot of closed funds that went together, and it's yielding 9.29. Being a CEF, of course, that means that the ability of buying that versus a ETF is their ability to have some leverage and to be able to buy it at a discount. And that's stuff we've covered under the CEF presentations.
And I think that statistically too, most of the return from these MLPs, up to 90% is income, and 10% is appreciation on average. And I think that even those that are more growth oriented have only about 30% appreciation. And so they do tend to be traditionally passed through vehicles. I know that's one of the questions we got. So is they are designed to be income producing instruments.
Yeah, these are
Cash flow producing instruments, I should say. Yeah.
That's basically what they are, and that's why this is an income group. So,
Yep.
And a lot of that is since it maintains the same tax benefits, a lot of it comes through as return of capital. So they're good vehicles for that. The second type of ETFs and CEFs on in the next page. Now that we get away from the 25% or more MLPs in a fund, we have to look at what these funds have been doing lately. Is they've increasingly been going and structuring themselves as a registered investment company under the 1940 Mutual Fund or whatever that act was, and yeah, and so they're going to own less than 25% MLPs, both as ETFs and as CEFs. And these are pass-through entities not subject to taxes at the corporate level. They can still be referred to as midstream funds. There's a few that have both the MLPs in it and the midstream corporates I talked about that just aren't MLPs anymore. But a lot of them have less than 25% MLPs in it, and then they have a lot of different infrastructure type funds separate from oil in it. But there's about a dozen of these I could find of these ETFs that are basically, they're still midstream, but they're less than 25% MLPs. The rest are regular corporation MLPs or other infrastructure type companies. They typically own US and Canada midstream companies. So for the other 75% of the portfolio, it can be, like I said, midstreams, or it could be utility stocks, power generating stocks, or toll roads even, or general other infrastructure stocks. Just like any other dividend type company, dividend ETF, that does have taxable income, these are best for your tax deferred accounts. Probably it's just, put your high income earning accounts in your tax deferred accounts. They're not going to throw off the benefits that an MLP fund will. And of course, these are another vehicle best for those seeking total return. I've given on the next page an example of 4 of these ETFs that are all less than 25% MLPs. And you can see the returns there, and they're not great. I don't know why Tortoise Energy Infrastructure is yielding 10.33. I just found that at the last.
Might be a lot of leverage in that one. Yeah. To take a closer look at that. Yeah.
Yeah, these are just ETFs, and that have the midstream in them, but they're not a lot of MLPs. And then we're almost done here. The same thing exists in CEFs, and these are the ones I like. That I kind of like is that you can buy, these midstreams in this 40 Act format as a CEF, and I found 3 of them: Adams, BlackRock, and BlackRock Energy and Resources Trust, which I own, which is just a CEF that yields about 9%, pays monthly. It's at a slight discount now. It's actively managed. It's a managed distribution CEF. It actually operates on no leverage. It only has 28 securities, and they do write some covered calls on some of their investments. And I've noticed that it maintains the NAV over time pretty well. And I don't think it has any MLPs in it, but I just put it in because it does have some midstream non-MLPs in it, RIC midstream fund stocks.
On that, probably because they're writing covered calls, and that probably stimulate or add some stability to the fund because of that cash flow that's coming out of writing those calls.
Yeah, it does boost the yield, and I found it to be a pretty good fund that I bought. It's just a $350 million fund. It's not huge, but it's managed by BlackRock. So, and then lastly, on the last slide, I've just put some overall investment guidelines in here that that people think, because midstreams don't ever own any of the oil, let's say, that they're insulated from energy prices. In practice, it's not exactly true. It's still better to buy when the energy prices are in the tank, and then that's the time to buy. It's up to you when you want to sell them, but I just hold them for income and whatever price appreciation I can get on them.
Well, and looking forward too, the demand for energy is increasing here, and with power demands for AI, and so we're seeing more and more companies, develop their own processing, electrical generation facilities, and also using oil and gas as power sources too. And so it's pretty busy down in the Permian Basin, which is, encompasses West Texas and New Mexico, and that sector of the domestic economy really produces more oil than any OPEC member except Saudi Arabia and Russia. And it's a huge number of barrels. I looked up, saying 6.5 million barrels per day coming out of the Permian Basin. And they'll also see, increasing demand for natural gas in addition to liquefied natural gas, as William mentioned. So there should continue to be strong demand in the energy sector. And it seems like this is a good way to play energy and also have cash flow and not just be a pure appreciation bet. So it's a way to get get that cash flow from a sector that has pretty strong fundamentals going forward. Demand for energy nationwide in the U.S. is much stronger than it's been in decades, and we're actually using more oil and natural gas, despite alternative fuel sources that have come to the fore and are being used increasingly. We're using more oil and natural gas than we have ever, actually. So, very, very strong demand. So these should be good instruments um, uh, going forward.
I went into when you own the individual MLPs themselves that, it's better to hold them in your taxable accounts. Um, uh, um, but the tax um, problems with it are great. I mean, some people will buy them in their tax-free account, but I just find it easier and better just to buy them in the funds, either the ETFs or CEFs. I kind of concentrate in the CEF area. You get good yields, pretty good diversification, and of course, a 1099. Some of them will offer leverage to boost the income, and a lot of them are selling at discounts. So you're getting the assets cheaper. When you're buying CEFs,
Excuse me.
you can
Uh, yeah, go ahead. I'm sorry.
the liquidity can sometimes be constrained, so you want to look at the bid and ask pretty closely. CEFs were in this packaging of these MLPs and now these converted MLPs to regular midstream corporates. CEFs were the first to do this years ago, but the numbers are dwindling. I listed the ones that I could find, especially of the pure play MLP funds. I just kind of summed up by saying, you can leave the ETFs to kind of like basic investing. And if you're a little more advanced, you can look into the CEFs. And that's about it.
Okay. I think we had just uh, looking through the questions here. Someone asked about if these instruments can be purchased on margin at all. And
Like any other stock, I guess if you have a margin account, you can do that. Remember, these are mostly income instruments. I don't know what margin rates are now, but they're. I've never bought these things for potential appreciation, and I'm not a trader, so I don't just buy and sell based upon the oil market itself.
Okay. Another question we had was, did you say that the distributions from the C Corps are considered qualified dividends for tax purposes, or was that just when they were in the MLP structure? I don't know
Um,
about the taxation, if that's changed with
see.
C Corp.
If it's just a C corp, it's just taxed like any other stock you buy. If the
Yeah,
you
they
know
really give up that favorable taxation then, don't they? It's no longer considered qualified dividends, probably. And but as you pointed out, William, and a lot of companies are converting from MLPs to C Corps because then they have control over the cash flow as opposed to being obligated to pay out such a high percentage like the REITs do, which is another reason why another topic, but other REITs are converting to C corporations too, so they have control over that cash flow and are not locked into a high payout rate when times may be challenging.
the key for pure play, like if you're buying just MLPs individually, is to really be getting a large percent of your distribution as a return of capital, lowering your basis. Um, but again, you're having to deal with the K1 to do it. But I just that's where I kind of think it's just easier to buy the funds.
Right, right. Well, and I think, yeah, and somebody was asking if you have an MLP issue, you buy one, then that would have to be one of the funds as opposed to an individual MLP and you get a 1099, then that taxed as ordinary income or qualified dividend. if it's any different if you give up the K1. Um, I don't know. Do you know the answer to that? Or did you go over that? I may have
Yeah,
missed that.
yeah, that's getting a little bit above my, I'm not a
Right.
tax
Yeah.
person.
I think we're going to have to research that one. So I think and another, we are getting into the tax questions here. That an MLP that's distributed incomes return of capital in the past. Um, this is and you say, well, and I bought the MLP and its initial capital gain is all returned. Does that mean you pay capital gain tax for the principal you pull out? And I'm going to guess that's probably the case because your basis has been adjusted. And so you're into a taxable portion of your return.
I just know once your
But
basis has been lowered by the distributions to zero, it just turns into a capital gains.
yeah, I think it does once it's done. Someone else asked about if there's any software that deals effectively with the K1s. Well, I think something like a TurboTax or something is going to address that. Now I have to say it's been a year since I've used TurboTax. I had to go to a CPA when I started rentals. So not sure about that, but I'd be surprised if uh, tax programs like TurboTax and TaxCut don't deal with that. So
They'll deal with it, but some of these K1s end up with these operations are in many states. And so
yeah,
you have to
right.
for every state, and then TurboTax is going to charge X amount, whatever it is, $50 more per state. And I don't know, and some of these are national operations operating in many states. So it is a nightmare.
It really can be. In fact, when I was managing investments for clients, I dealt with that, particularly for a client that had exposure in California where the taxes are very arduous. And it was very, very painful in terms of the return of how that was structured with an MLP where they had California exposure. And it really was not that big a portion of the portfolio, but it was a major tax headache and a lot of CPA time that they burned because of it just being so complex. Now, someone else is making the case that they've used TurboTax successfully in that in the Q&A section, so it wasn't that big a deal. It's important in TurboTax, and I believe the program has gotten more sophisticated over the years, so that makes sense. That makes sense. And of course, there's more than one tax program that people have. TurboTax is just the best known. And I know there's several products out there that I'm
How
aware of.
many states did he have to file in?
Yeah, that I don't know. That's not disclosed, but um, and then someone else asked, just again to summarize, they could review the main advantages and disadvantages of funds with more than 25% MLP exposure to those with less than 25%. Seemed like the C corps, a lot of the C corps had less than 25%. Didn't this is me talking now, William, in the examples you cited. So they had that flexibility to, if they had less than 25% of MLP exposure, is that?
Then
eh,
they're taxed as a regular corporation, and the kind of the reason why this has happened is because so many of the MLPs have rolled up into being C corps. So there's not a lot of them. There's still a lot of them, but as far as the big ones have changed over to being C corps. But that if you want MLP exposure, and you can either get it treated with more than 25% in the fund or less than 25%. And I've listed examples of both those.
Okay, okay. And somebody else pointed out that when you've got investments in Texas and presumably New Mexico, I would think too, in the Permian Basin, because there's so many holdings down there, that it's less complicated than, for instance, the California example that I cited. So, and so, okay, good, good. Okay, well, I think we covered most of the questions. that we have today. And so wanted to again reiterate that will presentation and a copy of the written presentation materials as well as a recording of the meeting today will be provided at a later date. We'll make those available. Those will be found eventually on the Portland site, the PDX AAI site, and we manage this again, the income and cash flow community for AAII nationally, but those materials will be on our site. We are going to have, we normally do these meetings about every 2 months or so, as often as monthly, depending on our speaker availability at the time. So we'll make you aware of those and watch for your emails on those. We're also we're putting our postings though on the posting of articles and follow-ups and things on the AAI community SIG site for income and cash flow. So be sure to check that periodically because we do post some articles as well as follow-up materials from some of our presenters that have presented at past meetings. So that's part of the activity that we'll put on those sites as well. And like to thank everyone for attending today. Like to thank both William and Gilbert for presenting, and Gilbert for co-managing, and our able webmaster John Wong for helping things flow smoothly behind the scenes. And appreciate everyone's participation today. And we'll look forward to seeing you all at future meetings. Thanks again.